Hello, everyone, and welcome to another YCharts webinar. I'm Joe Clevin, Product Marketing Manager here at YCharts, and I am joined once again by my colleague and good friend, Customer Success Manager here at YCharts, Tom Joyce. How are you today, Tommy?
I'm good, Joe. Thanks. I always appreciate you bringing me on here. So looking forward to reviewing another quarter in the books.
As am I indeed. And as we do every quarter, today we're reviewing our latest economic update deck with visuals and data summarizing Q1 of 2024. And our hope is that this data can help you kick off 2024 and navigate whatever is in store for the rest of this year. As we saw, we'll be talking about great equity performance in Q1. April was not so great, so we'll see what kind of setup we have for the rest of the year. And we're extra excited to dive into this new and improved slide deck that we have for you. It contains a lot of new slides, visuals, data points, which are all for your preferred use with your own clients and prospects, your colleagues at your firms, that all can be branded with your own logo and custom color scheme, etc. And we'll be covering most of the deck on today's webinar in just a slightly modified format. So be sure to download the full deck if you want to follow along and share those images with your clients and prospects. If you are a YCharts client, we're glad to have you on, by the way. Clients can access the deck by logging into YCharts, and I'll show how to do that here real briefly. On the YCharts homepage, or from anywhere in YCharts rather, from the support dropdown, you go down to Insights and Visuals. And here on the left-hand sidebar, clicking the Economic Summary Deck will have the latest version for you here. We offer it in PDF, which will open in your browser, or in PowerPoint format, if that is your preference. And past versions of the deck can be found in the sidebar here as well. If you are not a YCharts client, you can head to this page where all you need to put in is your email and it'll be available to download right from there. And you'll also get a copy sent to your email. We will go ahead and drop this link in chat for your convenience if you'd like to follow along. And speaking of chat, do note that we'd love to hear your questions as we go through the deck today. Submit those questions to us using the chat feature in Zoom, and we will answer them live. Nearly all of the data that we're covering today was published by various private and government agencies, and data is as of the end of Q1, which is March 31st, 2024, or in some cases, the latest available data as of that date. Just a couple of reminders before we kick things off. Please keep in mind that the content of this webinar is meant for educational purposes only and is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. I'd also like to point out that a recording of this webinar will be emailed to everyone tomorrow and will also be available as a replay on our YouTube channel for later use. Okay, so with all of that said, let's get to the main event. We'll be covering slides from the deck across these 4 sections you see on your screen. So I will pass it off to Tom to get us started. Tom, take it away for us.
Awesome. Thanks, Joe. So yeah, we're going to start with some market data, and we're going to take a look at some charts highlighting key stock market index performance here. So we're looking at Q1 2024. And we can see how the Dow Jones, the S&P, and the NASDAQ performed in the top left corner chart. And then down below in the bottom left-hand corner, we have the MSCI indices, tracking the emerging markets, the world ex-US, as well as the EFA. Now, in terms of performance, in the top right-hand corner, we had the S&P leading the way, hitting double-digit returns in Q1. NASDAQ followed closely thereafter, at just over 9%, and then the Dow Jones was just over 6%. So a really solid market for the domestic US markets. And then global markets followed suit. Emerging markets trailed behind the lowest, but it was still positive on the quarter. Ex-US and the EFA were relatively the same, between 5.75% and 6% returns. Looking at the next slide, which is the trailing 12-month performance. So this is looking at the beginning of April last year, 2023 through end of March, we can take another look at performance. So again, trailing 12 months, we can see NASDAQ has gone on a ripper, as has the S&P 500, up nearly 30% for the S&P 500. That's going to track the broadest companies in the US domestic market. So you're able to see what that performance looks like. We had the Dow Jones, we had the MSCI World, and the EFA basically tracking hand in hand. You can see that performance is more or less right on top of each other. And then emerging markets still has had a great rolling 12 months, returning 8.5%. Following, what all of the other indices have done, it's hard to, kind of compete with what they're bringing to the table. But all of these still positively performed over the trailing 12 months. And then moving on to sector performance. So we've got the chart on the left-hand side, and then the sectors on the right-hand side broken out into sensitive, defensive, and cyclical sectors. So on the left-hand side, easy to understand what's happening here in terms of the visualization. We can see energy kind of led the way here, whereas real estate is what brought us down. So it's easy to visualize that. And on the real estate actually was going to be the only sector in the quarter that brought us down. Everything else was positive, which was good. Joe, back to you on asset class performance.
Indeed. So some good performance there in the quarter. And looking at the asset class performance side of things, this table shows the performance of asset classes over different time frames. US growth was the top total returner in Q4 of 2023, with the S&P 500 coming in second and commodities not too far behind, all of which posted double-digit performances. Things weren't as rosy on the bond side of the ball, which makes sense given that equities rose. Muni bonds were down 0.4%, aggregate bonds down 0.8%, treasuries down 1%, with US real estate being the caboose down 1.2%. And as you can also see on the right-hand side, we do map each asset class to a particular index. So for example, all of the bond data that we're using, bond and treasury, are from Bloomberg, whereas the US growth, US value are from the Russell 1000. Then pivoting once more to performance of diversified portfolios. So as you had talked about there a little bit, Tommy, with the trailing 12-month performance, this chart shows 4 portfolio compositions at different allocation levels. So in the purple line, you have an aggressive 80-20, yellow line, a balanced 50-50, and in the blue line, a conservative 20-80, with the all-stock S&P 500 in green there. You'll see that in the trailing 12 months, all 4 of these portfolio types are positive. And in even more better news, they have all set all-time highs and have virtually no drawdown right now, maybe with the exception of the conservative, which is down 0.1%-ish. But you can also see on the right-hand side what the portfolio compositions are here, what funds we're using to build these, which you can also do in YCharts using the model portfolio tool. Big takeaway here, though, is that things through the first quarter of 2024 were very up and to the right for all 4 portfolio types.
All right. So taking a look at index concentration here. We've seen this slide in the past, but what we have are the SPY top 10 holdings and QQQ top 10 holdings as well. On the left-hand side, that's the data table we're looking at as of March 2024. So the concentration is still definitely elevated compared to historical data points. So just as a refresher, you can actually access up to 10 years of history on these funds. Not just these ones, any fund in our universe, you can say, what did it look like 10 years ago? So you can understand the composition. Now, if we were to go back and say, what did March of 2014 or April of 2014 look like? It's probably going to be pretty different. So the concentration is elevated compared to historical standards, and that's what's of importance to note here. Then on the right-hand side, we illustrate that further looking at the chart. So in this case, we're looking at the S&P 500 as the index as a whole. And then we're looking at the S&P 7 and the S&P 493. So we've talked about the S&P 7 at length. That really didn't give up much in Q1 of 2024. It kind of carried over where we were from 2023. It outpaced all of the other two indices on the chart, which is the S&P 493 and the S&P 500. Even with lower performers like Tesla, who had a rough Q1, well, those other securities really picked them back up. So that concentration at the top of the index is really what's helping us in terms of performance at the beginning of this year.
Tom, it's also interesting too that we've seen in the first quarter a rising tide seems to be lifting all boats in a way, which wasn't the case for the full year of 2023.
Yep.
Interesting how the tides have turned, and maybe a little bit toward the 493, which are the X Magnificent Seven, basically the rest of the index. This is a pretty popular chart amongst the YCharts client base, one that I've built many times myself. And I'm going to go into the tool real quick to show everyone how they can recreate this as well. If you opt into one of our client groups, it's our YCharts marketing client group where we published all these charts for your ease of use. You'll be able to access all this data and recreate these charts yourself. And if you go into a new fundamental chart here under tools, visualize fundamental chart, you can open a new fundamental chart. And once you're in that client group, which by the way, all you have to do is just email support@ycharts.com and we'll get you in that pronto. Head over to shared with me and excuse all my charts that are shared with me. I'm a bit of a nerd when it comes to charts, but we have this one here for Magnificent 7 versus 493. So this is that chart that you saw just through the full year of 2023. You can customize it to your liking by changing the start and end dates, like so. And for added emphasis, you can also go into the annotate function up here and add an area chart, which will, in this case, for the 493, highlight this all in red for added emphasis. You can also add a custom logo of your choosing to the bottom left corner here, and that'll populate on every chart, PDF report, proposal, what have you. It could be your firm logo, it could be a personal logo of your choosing, but anything you want here along with your custom color scheme will populate. And it's really that simple to get this chart and many more like it.
Yeah, really can't emphasize that enough, Joe. As an account manager here, my job is to work with our clients on a day-to-day basis. And to all of our attendees, it takes a lot of work, especially on Joe's side, to put this sort of content together. And so we know that advisors are typically pulled in a million different directions. Let YCharts do the legwork. Opt into this marketing group so that you have access. If you find this data interesting and you want to use visuals like this moving forward, opt in, reach out to your account manager, chat support team, as Joe mentioned, support@ycharts.com. We will get you to the right place so that you have access to this moving forward.
Indeed we are, and we're happy to do it. Now back to the slide deck here. So moving on then to our next section, which is macroeconomic data. We're going to start things off on this section with inflation and wage growth. So as of March 2024, the US inflation rate continues to hover in that 3 to 4% range, clocking in at about 3.5% in March. Core inflation has gradually come down from its high of 6.6%, also just below that 4% threshold, coming in at 3.8% for March. You can also see on the bottom the consumer price index gradually rising through the 2000s, 2010s, and coming along with that big inflation hit that we had around 2022, how that CPI really accelerated across that year. Seems to be going a bit more toward its historical trajectory with that 3 to 4% range, but still about 3 to 4% is where we've been looking at for inflation, steadily in that range for the last few months. And on a similar topic here, looking at the wage growth side of things, we have a chart here with US average hourly earnings and real average hourly earnings, which is adjusted for inflation, as well as a year-over-year view of how these have progressed. We do see that average hourly earnings has climbed steadily all throughout, again, the 2000s, 2010s, beyond the 2020 pandemic into Q1 of 2024. On the other hand, when you adjust it for inflation, it seems like average hourly earnings haven't actually gotten ahead all that much. We definitely saw with the rise of inflation around 2021 and 2022 that the paycheck power for these average hourly earnings did actually decline significantly despite the nominal amount rising rather steadily. So right now that figure is around 11.11, which seems to be actually a bit worse off than that spike right after the pandemic there in 2020 set on. Same thing with the view looking at year over year. That has actually declined in terms of nominal hourly earnings on a year over year basis, still up 4.1% year over year. But as we've looked at a look back period there, it's actually declined. And as you can also see on the bottom there, we were in the negative for inflation adjusted average hourly earnings up until about May of last year. So it is above water a bit, breaking that long cycle of lower average hourly earnings. So we will see if inflation can cool down, workers can actually get ahead a little bit more.
Hopefully.
And then last from me here is employment. We see that employment is at a job openings level of around 8.7 million, significantly down from its high of 12.18 million that we saw around 2021, 22 again. The unemployment rate does continue to hover around its all-time low, which is 3.4, came in at 3.8 in March, so a little bit above that all-time low, but still quite low, relatively speaking, dating back to 2000. And the labor force participation rate still hasn't eclipsed those pre-pandemic levels of around 63.4%, though it has steadily been rising since that pandemic first hit in 2020, rebounding all the way back to 62.7 as of March 2024. So if job openings can continue to be filled up, we'll see that purple line fall, and that labor force participation rate should rise and hopefully back above that 63% threshold and perhaps even more.
Fascinating. Thanks, Joe. Now, switching the page here, looking at some more leading indicators in data table format. So we can see there's about 9 metrics here on the left-hand side, ranging everything from the 10-2 spread to the S&P 500 performance to consumer sentiment, building permits, etc. What I like to take a look at first is there's a lot of green to the right, and that's historically. That's looking at that bull market period of 2012 through 2019, even parts of 2020 and 2021. You can see there's just a lot of like light yellow and green that's shown there. And then as you hit 2022, we can see there's more red, dark orange, etc. So it just kind of paints a picture without even knowing what the metrics are that more recently have been a little bit more trying than what we've experienced historically over the last 10 plus years. But what we can see, just a couple of metrics that I want to call out here. The second and third item being the New York Fed Business Leaders Survey of current business activity and the Philly Fed Manufacturing Activity Index. So those numbers of 0.6 and 3.2 respectively, basically if you're above or below 0, that's going to indicate, growth if you're positive, and then the opposite if you're negative. And those numbers have only ended positive at the end of each quarter, I want to say twice in the last 2 years, since early to mid 2022. So it's a really solid sign that we do seem to be trending in the right direction in terms of the actual economic indicators in that area. You can also see a huge spike in the US index of consumer sentiment, which is the 5th metric on the left-hand side, ended at 79.4. That's huge compared to the other numbers that we finished with at the end or toward the end of 2023. And then it's the highest number on the page anyway since 2020. So things do seem to be trending in the right direction. And then you can see housing starts as well. Housing starts are slightly, it just feels slowly but surely, they are starting to trend in the right direction. All right, on to the next slide of GDP and public debt. So US GDP, as of last reported, we're looking at 27.96 in terms of the nominal figure. And then the real GDP, which accounts for that inflation value, inflation adjusted, is going to be coming in shy of 23. So you can see since the pandemic, right, since that little drawdown that we're seeing, you can see those values have gone nearly entirely separate ways just because of how much inflation has impacted us over the last 3 to 4 years. And then down below, we're looking on a quarter over quarter level, and relatively in line with what we've seen over the average historically, and probably a good sign. Of course, we've had more volatility than we did in looking at the 80s through more or less the 2010s, but we do seem to be finding a bit of a glide path to be more in line with what our average quarter over quarter GDP value looks like. Okay, and then we're looking at public debt as well. So looking at public debt here, we can see we finished looking at 34 trillion in public debt at the top. So clearly we see that number has not been breached before in the data that we're tracking. So that's absolutely a massive number. And then that US public debt as a percent of GDP continues to stay elevated. So we're at 121.6% right now. Of course, we know since the pandemic that number has been elevated. We did see a slight decrease over time. Does seem to be elevating once more. So certainly something to keep an eye on.
Well, in pivoting from GDP to one of the major contributors to GDP is housing. We're looking here at mortgage rates and mortgage originations. So here at the top, we have the 15-year and 30-year mortgage rates, both of which stayed below 7% to close out the quarter, though they do remain elevated, with the 30-year mortgage rate finishing the quarter at 6.79% and the 15-year at 6.11%. As a result of these elevated mortgage rates, however, mortgage originations continue to remain very low, definitely relative to the low rates that we had in 2020, 2021 that were sub 3%. Obviously, you can see there mortgage originations were well over $1 trillion there. We're right now at 377 billion as of the end of Q1 2024, with the refinancing share down at a low as well of 22.81%. Not many people really feeling like they'd want to refinance here at these higher rates, which is why you have those low activity numbers there in mortgage originations. We did hear that the Fed's next move would likely be not to hike, I believe, Tom. I think that was yesterday. So we might see some relief here in the mortgage side of things, which might cause originations to go back higher. So we will see about that later. We also see, though, on the housing sentiment side, data here from the National Association of Home Builders and Wells Fargo. We have here the traffic of prospective buyers in purple, the present sales conditions for single-family homes in orange, sales conditions for those single-family homes in the next 6 months, they're in blue, and lastly, the overall U.S. housing market index, according to NAHB and Wells Fargo, in green. Seen some choppy waters for the NAHB Wells Fargo data. A lot of volatility here with how traffic of prospective buyers are feeling, overall sentiment, the sales conditions and the like. Currently, these numbers are a bit higher than what they've had in this sort of not even a V-shaped, but a W-shaped movement over the last year and a half, and certainly down from the relative highs that seem to have eclipsed 70, 75 on all four metrics. Again, with mortgage rates potentially looking to go down if the Fed does decide to cut as their next move following their May 1st meeting, which was just yesterday as a reporting, could see some uptick here in housing sentiment. And one last one for me on housing here is we're looking at home prices. So we're looking at the median sales price for new houses sold and for existing homes on the left. Definitely some choppy waters here as well because of these high mortgage rates. Values have come down a bit as sales activity has slowed from their peak for new houses, which is at 480,000, currently coming in at 430,000 and change for the end of Q1 2024, and a bit below 400,000 for existing homes. On the right-hand side is the volume of homes that have been sold. So as of the end of Q1 2024, new single-family houses sold were 693,000, definitely below its high of around 1 million in early 2020. And existing home sales are far below their high in around end of 2021, start of 2022, which was around and above 6 million, currently coming in at 4.19 million for the end of Q1. Not as low as that sub 4 million figure that we saw in the later stages of 2023 and early and maybe even late of 2022 as well, but certainly below the all-time activity figure that we've seen there.
And as someone who hopes to buy a house in the foreseeable future, who's to say if it's on the radar at this point? Time will tell. Okay, shifting into consumers and consumer sentiment. So taking a look at retail sales in the chart at the top, we're looking at retail sales on a year-over-year basis, the nominal figure, and then that real number again, which again accounts for inflation. So to the right-hand side, we did see another break, chink in the armor of the split between the nominal and the real value after the pandemic when that inflation value was so large. Now we're starting to see that come back together and be in line more with what we saw historically, which is keeping those two more or less the same. Now, looking at the bottom of the chart is the US Index of Consumer Sentiment. This is looking at a 30-year time frame. That 30-year average is above 86. We haven't been there since, looks like 2021. So we're currently below the average at 79 and change. We are on an upward trend, which is good to see. Hopefully we get back to that 86 number, but it is just something to note that the last time we were this persistently below the average is looking prior to that great financial crisis and then coming out of it. All right, so we'll pause there and we will shift into bonds and interest rates. So looking at interest rates and spreads. On the left-hand side, we've got the Fed funds rate, and then on the right-hand side, we're looking at the S&P versus the 10-2 Treasury spread yield. Treasury yield spread. Now, on the left-hand side, we've got the effective federal funds rate, and eyes always glare towards the huge spike that you see in the early 80s. But really, over the last 20 years, it's been quite consistent, right? You see some rises and then some plummets, and then some slow rises and then some plummets. That typically coincides, those plummets typically coincide with a recessionary period that's happening in the environment. And you can see we've stayed at 5.33% for about the last year. And you can see those timeframes more or less coincide with what we've seen with the previous rises. So it's just interesting to see what will happen moving forward, or if history will repeat itself in terms of how the effective federal funds rate has behaved in the past. And then on the right-hand side, again, the S&P 500 and the 10-2 Treasury yield spread. Now, what I found interesting here is this chart goes back to 89, which is how long we have data going back to the S&P 500. We actually have the 10-2 spread data going back to, I want to say it was 78. And what I want our attendees to look at is the spread itself has been inverted for about 22 months now. Let's say it was July 2022. Dating back to the data that we have on YCharts, which is approximately 1978, no inversion has been longer than that 22-month time frame that we're experiencing right now. In the early 80s, there was a period of about 18 months, and then it went positive again. And then about a year later, went back for about 20 months, but nothing has eclipsed that 22 months. So something to keep in mind that we are, it might not be as deep as it was, but we're still in that inverted period and have been longer than any of the data that we have dating back to 1978. And we can take a look at this further, looking at the true yields. And what we're looking at, basically on the right-hand side, are going to be all the different time frames in chart. And then on the left-hand side, we've got the durations, what the rates are, and then what that looked like on a quarter-over-quarter basis. So what we can see from the chart is those ultra short time frames more or less stayed the same. It's pretty flat in Q1. The 1 month dipped actually, the 3 and the 6 month weren't the largest of differences. Where we saw bigger increases were those intermediate to longer term timeframes. Those are increases of 20 or 30 or even close to 40 basis points. So we are seeing some elevation in those intermediate to long term rates.
The yield curve is absolutely fascinating, Tom. I think you
I
made
know.
points about it's been inverted for almost 2 years coming on. We've never seen that before. And everyone's wondering, when's the recession going to happen? Almost as if not if, but when is it going to happen? And I know that you'll talk about it actually in about 3 slides from now, which I
Right.
think will be excited to see. And before we get to our final segment, which is those charts of the moment, I'm going to hop into YCharts real quick to show you all how you can access a template just like that yield curve chart with just a couple clicks. So back here in fundamental charts, from the tools drop down under visualize and fundamental chart, you can head up here to new fundamental chart, click new from template, and head down to economic data. And like Tom, you also showed the 10-2 Treasury spread versus S&P 500. That is also a templated chart we have on offer where you click this button, click next, and that chart you saw a couple slides ago will load just as you saw it. If you head down to the bottom here, we have another template that's a yield curve analysis, which has every duration on the curve right here as an indicator. And just like that, there's your chart. You can customize it further to go back 3 years, 3 months. You can put in a custom date range to drive that story of how the yield curve is looking at any particular moment, whether it's like it is now where it's inverted, and maybe what a normal yield curve should look like, which is more of that July 21 era right here. Again, your custom logo can be embedded on any chart. It populates automatically, and you can also set up a custom color scheme to reflect your firm's branding. All fantastic features we have, and just saves advisors and all of our users a plethora of time.
100%.
Well, then with that, let's get into our favorite segment amongst our audience and our final one of our time here today, which is our charts of the moment. So the first of the 5 we have here is the money supply. So the money supply has been in big discussion since 2020 when we had all of the stimulus bills, as well as a lot of quantitative easing, very easy fiscal policy. We have here 2 charts, which is M2 and M1. Just as a little refresher, M1 money supply refers to the measure of money supply that includes readily available liquid financial assets. And we're talking here just currency, dollar bills in your wallet, traveler's checks, demand deposits, and other checkable deposits. M2 refers to everything I just said about M1, plus those held mainly by households, such as savings deposits, time deposits, and balances in retail money market mutual funds. So very liquid assets, easily convertible to cash. We see here that the M1 money supply in the yellow line quadrupled in 6 months' time between March and September of 2020. It rose even further than that to have nearly quintupled at its peak in April 2022 at a high of $20.7 trillion. Now it's contracted by 13.3% since then, or nominal figures 2.7 trillion. The M2 money supply is 1 trillion or 4.3% below its all-time high of in March 2022. On the bottom is the spread between M2 and M1. So historically, we saw a rising spread in between M2 and M1. That changed when we had stimulus and easy fiscal policy in 2020 to 2021. That spread plummeted, and now it's slowly recovering back up to where it ought to be or where it has historically been, but it certainly is a long way to go for this normalization to even back out from this quadrupling of the money supply we saw back just 4 years ago. A couple charts here that are also fan favorites amongst our YCharts clients. We do winners and losers scatter plots showing the S&P 500 constituents and who had a positive quarter, who had a negative quarter. We also do these charts on a half year and a full year basis as well. But here we're looking at Q1 2024 and the winners and losers. So out of the 500, 370 of them posted positive returns in Q1. So in other words, about 3/4 of the S&P 500 had a good quarter. The best performer, which is this outline Caitlin Clark-like little green dot right here, which is going to be Super Microcomputer. This company finished up 255.3% in the quarter. The worst performer, perhaps surprisingly, was a Magnificent Seven constituent. That is Tesla down here, which slumped 29.5% in Q1. We have a variation of this chart which excludes Super Microcomputer to give a more zoomed in view of the remaining 499 constituents here. You can see Tesla down here with being that laggard at 29.5% underwater in Q1. But both of these charts are again available to YCharts clients who opt into our client group, and these watch lists are essentially shared with you in your account, and you can build them very easily like so. If you head into tools and instead of fundamental chart this time, we'll keep within visualize, but go to scatter plot. You can simply open up this chart shared with me, and you'll see that the creator of it is YCharts Marketing, which is my team. And by clicking on either of these charts, these will load automatically. That took, what was it, Tom? 3, maybe 4 clicks to load.
Yep.
Once again, your logo populates right here automatically. You can set custom colors if green or red is not your preference, but you're then able to export to an image. You can also share directly to Twitter or with other members on your team who use YCharts. If you wanted to build these yourself or maybe add on an extra indicator, say you could throw on QQQ, and that will also populate on the chart to give you some comparison of how things turned out. Can edit that color here so it's not terribly contrasting. Can make that pink to stand out a little bit. But a very underutilized tool, in my opinion.
Yes.
Lots of great things you can do with scatter plot, and we are happy to build that data for you. And we do build that data and these charts as well for your ease of use. But lots of interesting performance here in Q1, and we're off to a rocky start in April, as we know. So we could see a lot more red next time around versus green. We'll see in a couple months' time, though.
Yeah, that's a great point. All right, crude oil. So what we're looking at here is 3 separate charts of the WTI crude oil spot price at the top, US retail gas price in the middle, US crude oil in the strategic petroleum reserve stocks at the bottom. So I want to actually start with the chart at the bottom, because this is what's going to be telling for what we're seeing at the top. So we can see this data was basically started to be tracked. The Department of Energy enacted this in like mid 70s. And so they said, all right, we're going to start loading up on these reserves. So you can see that's where that steep climb is coming from in the beginning of that data set. And it more or less flatlines once we get to that 600 million number, which is about where that average is. You can see it more or less flatlines at that number. We increase a little bit over time in the early to mid 2000s, but then we more or less stay at that true number. And then we see a steep decline in 2022. And when I say steep, I say we haven't seen that number. Like if we're traveling at 600 million for more or less the most part at that average, we're at 363 right now. So we, cut that reserve in half. We haven't seen those numbers since we were starting that stockpile in the late 70s or early 80s. So it just gives you a sense as to where we're at when it comes to that reserve barrel amount. And that will help paint the picture as to why we are seeing elevated prices in those charts above. So we're looking at the WTI crude oil spot price, which its average is typically $47. Well, we're close to doubling that at that number. So we're at almost 84 as of March close, as of Q1 2024 close. And then you can see kind of the same idea with the US retail gas price. So the average since 93 is going to be 2.3.5, 2.4, and we're well above that at a 3.6 number. We are off those highs, which is good to see, but we are flatline. We seem to be stalling out above what the historical average has been. So it is just something to keep an eye on. All of our advisor clients, well, all of your clients are buying gas and they're all paying for things like this and they're seeing elevated numbers. This can help paint the picture why. All right, shifting into some of our earlier conversation is taking a look at the yield curve, which we've seen previously, but now we're pairing it with, okay, what are the thoughts on recessions? What's the probability looking like? So those rates we're seeing in the top left-hand corner, we can see that they've jumbled together. They've stayed elevated over the last few years. Well, the recession probability has also remained elevated. So we were at 70%, the chart below the rates. We're not looking at the one on the right yet. We're looking at the one below the rates. So we're looking at nearly 71%. That 70.85 was the high over the last 10 years or so. And we came down briefly, but now we've increased that number back to 58.3. So much like what we've seen with other data points, we do seem to be stalling, perhaps at an inflection point in the market. And then on the right-hand side, we are looking at that same value that we were looking at down below, that 58.31, but now we're looking at it at a longer track record. So that goes back to 1960. We can see we're still at an elevated level in comparison to previous recessions. So when you take a look at, when you take a look at the Great Recession, financial crisis, when you take a look at the dot-com bubble, when you take a look at the early 90s, you can see that we're far and away above those numbers, right? So those recession probabilities do remain high, despite what perhaps the market is telling us in Q1. All right, and I believe that this is our last slide, so we'll try to make it count. Taking a look at the VIX at the top and then bull-bear spread at the bottom. Looking at the top, we can see the VIX continues on a decline, which is excellent news. If you take a look at that average of 19 over the last 20 years, we're sitting at 13, probably feeling pretty good. That decline continues. The low is 9. So we're in regards to the average, we're closer to the low than we are to the average, which is pretty impressive. So let's hope that that trend continues. Looking at the bottom, US investor sentiment on a bull bear spread basis. So this is telling us we've got historically over the last 20 years a little bit more bullish than we are bearish. We are through the roof right now in terms of the bull bear spread. We are extremely bullish in this survey, in this sentiment survey. Now, we can see there was, we're kind of in the last 3 to 4 years going through a V shape or a U shape, if you will, where we went pretty heavy on the bears. Now we seem to be swinging back out of that. Hopefully we can sustain that bull bear spread sentiment in the bullish favor. So that's where we'll leave you. Hopefully we're on to bigger and better things with the market and the economy on a bullish tone.
And hopefully we are after that rough April that we just got through.
All right.
Hopefully people aren't thinking about doing the age-old, what is it, the Adam of sell in May and go away.
Mm-hmm.
Or more funds flow into the market. Maybe with that news of cutting rates that Jerome Powell said, that might spur some investors.
Yeah, we'll see. Buying opportunity.
Yeah, right. There you go. Everyone's a winner. Well, thank you, everyone. That is indeed our last slide of the deck. And we do have a couple questions that we will answer in the chat. While we're doing that, please feel free to type any questions you have in from our presentation here about what you saw, economic questions for us, market questions, about YCharts, getting a subscription, whatever comes across your mind, please put in the questions here. Brian asks, is it possible to get the economic deck white labeled so that our firm can put our own logo onto it? Super question, Brian. We do hear this one a lot. You are free to use this deck as you please, is the simple answer there. You are free to take the charts and put them on your own deck with your own branding there. You can take the links as well and put them on the deck so that any colleagues or clients can access them in YCharts. Additionally, you are free to download the deck in PowerPoint format in addition to PDF format. But the PowerPoint format will allow you to make customizations and edits as you like. So for example, if you'd like to remove this YCharts logo in the corner and this little green triangle, you're free to do that and then customize it as you would like. So thanks for the question, and we hope you can download that PowerPoint version of the deck or take the charts for your liking and build your own content. That would be super. Well, with that, this will be a last call for questions, but once again, we will send a recording to everyone who registered for today's call, so be sure to check your email tomorrow. To get a full copy of the economic summary deck, in case you missed it the first time, just head over to our support section here, which is under support on the top drop-down, then insights and visuals. Click economic summary deck here on the left, and Q1 will be waiting there for you. One friendly compliance reminder that none of this is investment advice, and YCharts is not acting as an advising party regarding client funds in any way. Thank you once again, everyone, for joining. We were delighted to have you on our Q1 economic review. Tom, it was a pleasure doing this with you as always, and we will see you next time for our Q2 economic review. Take care, everyone. Thanks again.